Many new traders fail to identify key areas of interest when studying the chart, not knowing how to look for high probability areas to buy or sell from. This video, I will break down one of the core concepts of SMC trading, order blocks. I will show you how to identify order blocks, the 4 different criteria for a high probability order block, and live chart examples of how to read them. So take out your notepads and start jotting down notes because we are going to go in depth. So let's get this thing started. First things first, understand how order blocks or the idea of how smart money concepts work. Okay, smart money concepts stems from the idea of banks actively manipulating the market. Okay, so when you actively manipulate the market, or let's say I'm bank A. Okay, what I want to see, right? If let me give you an example. I want to buy gold. Okay, and gold currently is at $2,000. Now, some of you guys here have already heard this before, but if you guys are new, right, take note of this analogy so that you can understand. Okay, when a bank wants to buy gold, let's say I'm bank A, I have $10 billion worth of assets as a example number. Price here is at $2,000. Okay, $2,000. Price dips below, right? And they think that, okay, look, $2,000 is market price right now. Premium members, do you guys think as a bank, would you want to buy at market price or would you buy at a discount? Let me know. Discount, right? Definitely discount. Yeah, so with a discount, what actually happens is that what the banks will do, because they have so much liquidity to pump into the market, they can generate sales on gold, right? So let's say I allocate $1 billion worth of my assets to sell gold. So gold, let's say, goes from 2,000, which is this horizontal line over here. It comes down to, let's say, 1995. Price comes down, right? And of course, when the market dumps, everyone else is also going to be looking to sell. The retail traders are looking to sell because they are FOMOing in, right? So what happens? Price comes down a little bit more, and then let's say if the price right now is 1993. That's a $7 discount on gold. And imagine you still have $9 billion worth of assets to buy gold. $7 is a lot of money when you multiply it. So therefore, as a bank, I can choose to buy here at a discount. That's when the bank decides, okay, look, 1993 is a good level to buy. Let's pump in the rest of my $9 billion worth of assets to push the market up. Now, do take note, the sales that they created from here at $2,000 all the way to 1993, right, is still open. When they put in this buy order, this sell is still open. Okay, so now, of course, with their $9 billion sales, their profit definitely outweigh their drawdown. Very good. So it seems like you guys understand that it is basically going to outweigh their sell position. And that's why they pump in $9 billion worth. Right? So now, of course, at this point here, they're like, oh, look, it's 2000 and what was it right now? 2030 or 2400. It pumped out like crazy, right? For example, they decide, okay, I'm going to take my profit. So when they take their profit, you understand when they close their buy position becomes a sell position in order to cancel out the buy position, right? Because the market is a zero-sum game. So when they close, what happens is price will start to retrace. And when price retrace, price comes back to where their initial sell position was opened. And this is where the order block, or this is where basically their sell position can be closed at break even. And this way, they don't lose any money at all. Not on their sales, not on their buys. Okay? Can you guys understand this analogy? How do banks manipulate so that they win every single time? Understand? Very good. Now, with that being said, the definition of an order block is the last manipulation made before the real move happened, the real impulse move happened. This is exactly what an order block is. The last manipulation caused by the market, right, before pushing in a direction with volume. Okay, so this is the definition of an order block. So if I were to flip this around, right, if I were to flip it to something like this, the bearish scenario, right? If I'm looking for a bearish order block, I'm looking for the last manipulation that came up and pushed price higher before breaking structure on the left and pushing lower with an impulse. This would create the bullish order block. Okay, so now this is a line chart. I'll show you guys with a live example later on. So if you guys understand this, type 1 in the chat. I will move on to how to identify high probability order blocks. So for OB, what time frame do you look at? You can look at You can look at it in any time frame. But of course, the higher time frame the order block, the stronger the order block is. Like I mentioned, higher time frame, your points of interest are stronger, your zones are stronger because they are larger orders. The higher time frame order blocks are stronger compared to the lower time frame, like the 1 minute, 3 minute, 5 minute, right? So therefore, high time frame is always stronger. With that being said, let's go through the few criteria as to how to get a high probability order block. First criteria, okay, for a high probability, let me just type this. Here are the criteria. Number 1, liquidity must be swept. Okay, what does liquidity must be swept mean? Okay, so let me just make this smaller so that we have more space to draw. All right, there we go. Liquidity must be swept. For an order block to be high probability, liquidity must be swept. Let me give you an example in terms of line drawing. Okay, this is what it's going to look like. Price action. What you want to see is for price to continue. If let's say you're in an uptrend, right? Price does this, breaks below this higher low, and continue pushing upwards. In this case, price has taken liquidity from here. When you have a liquidity form like this, price sweeps it and continue pushing higher, creating a break of structure here, creating your bullish order block where this manipulation happened. This is where a high probability order block will form. Okay, this is what you need to take note of. Ideally, you want to see a liquidity sweep below a low or a high, depending if you're looking for a bullish or a bearish order block. Okay, something like this. So if I were to flip the charts, it's going to be the same thing, right? You're looking for a sweep of a high before a break low, a continuation break lower. So let me give you the other scenario, like this. Breaks the high, continues lower. This POI here will be a good POI. This order block here will be a good order block because of the fact that it has swept liquidity to drive price even further down. So this is criteria number 1. Okay, the idea here is that you want to see price break above this area here with volume. It has to close with a body candle close for it to be considered an order block. Right? Structure has to break. Okay, same thing here. You have to close below this low to confirm a structural break, and therefore this manipulation is confirmed, and therefore this move here is considered an impulse move. So when it creates either a lower low or a higher high, meaning it's swept liquidity, is then good for an OB. Think of it this way: in an uptrend, you want to sweep a higher low before creating a new higher high. Very, very simple. In an uptrend, you're constantly creating higher highs, higher lows, high highs, higher lows, high highs, and then you have a sweep of the higher low before continuing higher. Okay, same thing is the exact opposite for the bearish. Okay, price is creating lower highs, lower lows, lower highs, lower lows, sweep of the lower high, continue create lower low, and this PY will be a good PY already. Let me continue with the second point that I'm looking for. Okay, the second point, number 2, fair value gap and displacement must be seen. Now, what does this mean? Yeah, so basically displacement tells you that the market is displacing in the opposite direction. So for example, in an uptrend, right? So basically it's a change of character of sorts with a fair value gap confirmation. So let me give you an example like this. Price goes up, right? You sweep some sort of liquidity over here, or let's say a previous high, breaks lower. Now, in this break lower, there is a formation of a fair value gap. This is what we call displacement. You are displacing a low as well. Okay, so when you have a displacement, this is what happens. Price displaces the previous low because this low has been taken out, and you have just created a fair value gap. This fair value gap here tells us that there is volume in the market to keep pushing lower. So you must have an order block formation with a fair value gap, given that it has already displaced a structural high or low. Okay, it doesn't have to be a change of character. So this here, in this case here, this is a change of character, which is a displacement, right? There's another scenario where you can do this, right? Price come up, come down, come up, come down, sweeps, breaks and displays this high. continuing the uptrend, which is also a displacement. Okay, a displacement means that as long as you take out a high or low with volume, and how does that volume come about? You can really tell by the fair value gap that forms, which can be seen here. So the fair value gap must be formed during the impulse leg. Okay, can you understand this? So when I draw my order block, right, it could be here or perhaps maybe in this leg up here, you have an order block. Let's say for example the order block your order block is from here to here. It is coupled with the fair value gap. Simply put, you want to see both fair value gap and a displacement out of a structural low or high. Then you have a high probability order block. Okay? Now, fair value gap in itself will be a concept for another day. Okay, but put it simply, it's a 3 candlestick pattern where you take the top wick of the first candle and the bottom wick of the third candle in a bullish market. Whereas you're looking for a bearish fair value gap, you're looking for the bottom wick of the first candle and the top wick of the third candle. The gap in between is a bearish fair value gap. Okay, so this is how you look for high probability order blocks. Okay, and most importantly, a high probability order block also comes from higher time frame intentions. What does higher time frame intentions mean? It means number one, you understand where your direction is going on the higher time frame. Let's say you form a bullish order block here. Your high time frame is also bullish. Let's say your 4 hours bullish, this is your 15 minute. 15 minutes swap the low and then push up higher. This tells me that price action has a strong probability or high probability for price to come back down and tap this area to continue going higher because your 4 hours bullish as well. So this is a sweep of liquidity that happened and price continue to push higher, continuing the break of structure towards the upside, creating a bullish order block with a fair value gap presented. Now, for me, if I see an order block form without a bullish fair value gap, so in this case here, in a bullish market, I see an order block form without a bullish fair value gap, I most probably will wait it out and be patient. Because of the fact, fair value gap shows me volume. If price creates a wick out, wick down, wick up, wick down, wick up, wick up, and wick down, means that on the lower time frame, it's really generating liquidity. We need to see volume push up with conviction, with strength, showing us that the market is one directional, trending. Okay? Can you guys understand this? Yes or no? So number one, you must see liquidity swap. Number two, you must see fair value gap. Okay, number three, you must see your high time frame intentions. One more thing, number four. What will be even better is if you have inducement. Okay? What we have here is inducement. Okay, now what do I mean by inducement? Let's say, instead of having a straight retest down, right, you have something like this. Okay? Price do this. And then, you see a sweep of this liquidity here to continue higher. Basically, price tries to tap into the order block, but fails to tap into the order block for whatever reason. It's generating liquidity like this. Okay? Like this. Price is generating liquidity before the order block gets tapped. This shows us that it's high probability that price action will come back and retest the order block to take out this liquidity and at the same time collect more orders at the order block. So for order blocks, see it as a way to collect more orders to push in this initial direction that it wants to go. Okay? So same thing over here. Same thing. If let's say you have a bearish order block over here. Oops, not this line, but a box like this. Order block. Price comes up. Fails to tap into it. Comes down. Comes up again. Creates a high. And then pushes up higher finally. And then dumps immediately. Okay? This is also considered inducement. What is the inducement? These highs here that didn't test the order block. No, not EOS. Inducement, which is your liquidity. Okay? So can you guys understand? There are 4 criteria for you to have a high probability order block. Must inducement be at the same time frame as the order block? Well, you can have the inducement at the same time frame as the order block, or you can have it on the lower time frame as well. That's also fine. Inducement is basically where you have highs or lows that basically don't do anything. They're not testing a POI like a fair value gap or an order block. It's just a retracement that didn't do anything. So therefore, it doesn't create enough orders for price to push lower. So that's why price needs to come out and take out these inducements, these stop losses that retail people are putting, thinking that, oh no, price is rated at high here, let me put my stop loss here. They get wiped out, and then price continues lower. It doesn't have to be relative equal highs or low, right? But relative equal highs or low also count as inducement. It can be a high that, for example, in this case here, came up like this, right? And didn't touch anything. Then came down, failed to break below. Or break below with not much volume, and then price comes all the way up into the actual order block itself and then continue dumping. Yes. Can you guys understand this? So like I mentioned, don't put too much focus on the fair value gap right now because of the fact that we are just focusing on order blocks. But fair value gaps will be something I will cover in the next lesson, okay, which will be next week. But right now, just focus on the order block. The idea here is that when you see a retracement and the retracement doesn't tap into the order block, and price continues lower for a little bit, thinking that, oh no, price is running away from me. It's not. It's creating inducement for price to potentially come back into your order block to look for potential buys or sells. Okay? Very good. So these are the 4 key things that you guys need to take note of. Number 1, liquidity. Number 2, FEG. Number 3, higher time frame intentions, which is your higher time frame, knowing whether you're bullish or bearish. Number 4, you have your inducement. Now, with that being said, let's move on to the live examples. Let's go to the live examples. Let me show you guys on Gold. Let me just flip back my screen. What about freshers and unmitigated? Yes, I'll explain it with the live charts. All right. Let's take a look at Gold and how I would identify my order blocks. Now, as you can see here, right? Price is going up in an uptrend. We sell to buy. Now, when you sell to buy like that, breaking structure towards the upside, where is your order block, ladies and gentlemen? From here to here. This is the manipulation down before a push up. Okay? Now, when you have this order block here, price is expected to come back and tap into the order block before going higher. Right? Because this is where the banks and institutions will take the profit and come back and retrace to close their sell positions. So same thing for OB. So once price creates that, price continue pushing higher. Like this. And now we have another break of structure. So now, where is the order block? Is it going to be from here? Or is it going to be from here? The bigger one or smaller one? Chat, let me know. Good, I see some of you guys get it. The answer is both. Okay? Now, let me tell you guys the difference. This is how you refine your order blocks. Okay? So you must understand that the initial manipulation starts out from here. 2288. Come all the way down to this low and push up higher with impulse. As you can see, we have a fair value gap as well, which is good. Right? So that means that this order block itself will hold or should hold because it's high probability. Now, you take a look at the smaller one which I drew here. Why is this also an order block? Right? Because the idea of a manipulation is the last point in price created to manipulate the markets before pushing up in its intended direction. So think about it this way. In a bullish market, for an order block, you should be looking for the last down move that created the lowest point in price before pushing higher. You must understand, you must identify the candle that creates the lowest point in price before this high was created. So if let's say you see this high, where is the lowest point in price? Price actually went after breaking this level here, this low. The green body candle still had the lowest point, correct? Exactly. So that's why the body candle color doesn't really matter as long as you identify the lowest point. Yes, regardless of color and direction. So if this candle was red and then the next candle pushed up all the way, so what? This is my order block. Because this created the lowest point in price that manipulated, right? That the banks manipulated before pushing higher. So therefore, this is an OB. And what is KUC? Price came back. Now, what is this action of price coming back into the OB? This is what we call price mitigating the order block. Learn this new word. It's called a mitigation. For those of you guys here that don't understand that, right, it's basically price coming back to fill orders. Unfulfilled orders that are here. Okay, think about it. These people, they entered sell from the top all the way to the bottom to create this low, to manipulate price, and their sells are open as price went all the way up. So therefore, we are expecting price to come back down to mitigate this level, to test the level, so that the banks can close their sell positions. And when they close their sell positions, what happens? Their sells become buys, because that's just how the market works. It's change of hands, right? So their sells will become buys, and therefore they can also look to stack buys at this area, because this is a discounted area for them to buy. Yes, basically the banks want to come back and close their position at break even, or maybe a small profit for their sells. How do sells become buys? Please re-explain. Understand, in the market, it is a zero-sum game. When someone is buying, right, the other side, someone is losing money. Because it's not how do you make money in the market. If I long, someone else is short. If not, the order won't fill. Okay, you must understand this. So when you have that, let's say you place a stop loss. Right? You close out a stop loss position. Let's say your stop loss is here for buys. Right? Price takes out this low. Your stop loss for buys becomes a sell stop, because it will get triggered. Right? So that's why your buys become sells and your sells become buys. That's how they execute your stop loss or your take profit. Same thing. If let's say I set my take profit here, price breaks through it, then good. That means they will close out my sells. They will open a sell to close out my buy position, so that I'm no longer in the position and I'm net zero for the position at this point in price. There's also going to be a premium discount array. PD array, basically your fit from your swing low to your swing high. If you see an order block at a discounted area in an uptrend, then more than likely the order block is going to be respected. It becomes higher probability as well. All these layers of confluence, okay, there are four. Number one, there's sweep. Number two, you have a fair value gap plus displacement. Number three, your high time frame bias, which is longs, as you can see. And number four, what do you have? Fill in the blanks. Inducement, correct. And where's the inducement here? This level. Price came down, tried to push higher. Oh no, price is going higher. No, price came down lower to tap into the order block. There we have it, your inducement. Liquidity. Okay? You can see, that's why this order block here held up so well. As price continued to push higher, what do we have now? A new order block. From here, the highest point in price, all the way down here. This is now your new order block. Ladies and gentlemen, order block. As you can see, price stepped into it, continue higher, then came down. You can see, this was the last point in price before price continued higher. Okay, and when price comes to retest, then what happens? Respects the order block, continue higher again. OB. And now, once we break above this high, okay, we body candle close once again. We now have another order block here. Order block. See, price respected the low, respected the order block, continued to push higher. Why did we use two candles instead of one? Very simple. Order blocks here are as refined as I can. So if let's say I want to refine this order block here, I can use this one here. Price never tapped into the order block. But where did the manipulation truly start? From here. So this is also considered an order block. So let me just remove this just to clear up. As you can see, price is following the bullish order flow by respecting the bullish order blocks. So to refine the order block, you confirm later from later candles. So yes, correct, exactly. So let's see price pumped up here already, right? If you want to refine your order block, you can keep it to this smaller one. But of course, the problem with refining your order block is sometimes you don't get entries. Because price means just tap and go, just like this. Price tap and go. For the last order block, I draw got no FVG. Correct, exactly. Which is why I took a short instead of a long at this point. Because there were lower time frame confirmations. Right? If you take a look at this 1 hour order block, there is a fair value gap. Order block, the last sell before price broke up above here. Right? You have a change of character, creating an order block. Where's the fair value gap? Here. Bam! Filled the fair value gap, tapped into the OB, respected the OB, continue higher. So like I mentioned, you can draw your order block on any time frame. What are the pros and cons of order block? I'm coming towards the end here already. Don't keep up too much of your time, but the idea here is, what are the pros and cons of order blocks? Number one, you have to understand the order blocks help you get more sniper entries instead of just entering at the break of the high, or perhaps maybe looking for a break retest continuation. And order blocks is there to tell you where the initial move started to pump or dump from. And price action most of the time will come back to these areas. So if you use order blocks, you must understand you will get sniper entries. So for example, you enter here, stop loss below here. Let's see, if you were to just trade off order blocks without any other concepts, you target, the higher high, right, all the way up here. Let's see, you do get sniper entries, except for this one here. Now, the next thing you must understand, if you trade only using order blocks, your stop loss is going to be smaller. And order blocks can be confusing. So that's why it's important to have higher probability confirmations, which is your number one, your liquidity sweep. Number two, what do you have? Chat. List out the confirmations for me so that you know yourself. You repeat this to yourself. Fair value gap, okay. Number three, displacement, which is also part of fair value gap, so that's not number three. Number three, higher time frame intentions, correct, very good. You have your higher time frame intentions backing you up. And number four, inducements, very good, excellent. Okay, so this is what you should be having for your order blocks. Okay, so keep this in mind. Go ahead and practice as much as you can. Try to do it on the 4 hour, right? If, for example, if let's say, let me give you an example on, let's say, GU, because I'll be explaining GU in a short while, right? Now, on GU, let's see if we can find a higher time frame order block. Where did the higher time frame order block come from? Okay, we have a buy to sell. So this is a higher time frame order block. Did this order block create displacement? Yes, it displaced a low. Did it create a fair value gap? Yes, it did. So price tapped into it. Oh, yes, one more thing. Did it create an inducement? What is this high? Did it tap into the order block on the daily time frame? It didn't. It was so close. Tap. Look at this. This wick here didn't tap. So price took out the inducement, tapped into the fair value gap, and continued bearish. Therefore, this is a high probability area. Okay? Nick, can you explain inducement once more? Okay, pay close attention. Inducement is when you have a high that doesn't tap into a strong POI, like a fair value gap or an order block. But in this case here, we have tapped into the order block, but we have tapped into the fair value gap, but not the order block. And as you can see, after the push lower, price failed to create lower prices. So therefore, this here doesn't become a strong high. Price is still retracing. So because this didn't create a lower low, this is considered inducement. Price should continue to come and mitigate the order block, which is here, the test of the order block. Okay, before price comes lower. And ideally, when price comes lower, you should wait for price to continue the break of structure, and then you have a new order block. And when you have this new order block, I shouldn't be seeing price continue to take out these highs. So this order block you can just ignore already because your strong high is going to be here. Yes, we are getting this recorded as well. Okay, so now that you guys know how to use order blocks, right, you can also look to learn how to refine them. Lower time frame, how can I refine my 1 hour, my 4 hour order block, right? The last up move that caused the high, which is this one. This candle. Okay, this candle here. Did it sweep previous highs? Yes, it did. Swept this high and then created a displacement. Yes. So now with that being said, let's take a look at one last example of structure. Okay, of order blocks before we move on to the trade breakdown for GBP US dollar. Okay. Now, if you take a look, price action here broke this level, right? Price broke through this lower high. Here we change the character. Now, where is the order block? The big green candle. Very good. This is the order block. Very, very good. The last candle that created the highest point in price. This is the last candle that created the highest point in price. So this is our order block. This green candle. And what did price do after testing it? Test once, test twice. Then price created a shift, creating a change of character. Okay, so now what do we have? Another 4 hour order block. I refined it to this candle over here. So some may say, okay, look, Nick, why don't you put your candle like this? I could. But at the same time, if you take a look, price created a 4 hour fair value gap within this order block. So I can put it to here. Because you understand that on the lower time frame, what do I see? This was where the manipulation started, not here. As I'm going through this live chart, you are seeing live examples of how to draw order blocks so that you can draw this high probability order blocks yourself. And as you can see, price also swept liquidity, swept these highs, liquidity taken, and came down lower. Okay, and on top of that, we also have inducements. These two highs here didn't do jack shit. It didn't do anything. So price is most likely to come back out into this area. So yes, this is how you tell price action, right? How you read order blocks and how you draw your order blocks in conjunction with structure, market structure. That's why I went through market structure mastery yesterday. It's very important for you guys to know how structure forms first before you understand order blocks. That's it for the order block mastery video, teaching you all you need to know on how to identify high probability order blocks and using them together with other concepts. I hope you have gained value from this video. Make sure to implement, backtest and forward test this concept with your trading plan for the most optimal result. I'll see you guys in the next video. Bye bye.